Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal, The Quiet Constraints. When jobs get revised and the grid gets tested. The story always looks clean in real time. And then the revisions show up. That's the first pattern I can't unsee in today's set of pages from the Wall Street Journal. We build narratives off noisy first prints, we price assets off those narratives, and then, months later, the system tells us what actually happened. This episode is going to be about constraints, not the sexy kind, the boring kind that compounds. Measurement constraints, energy constraints. Because in business, the constraint is the strategy, whether management admits it or not. And for investors, understanding the constraint is often the difference between owning a compounding machine and owning a story. Now, before we go any further, I'm going to follow one rule. No politics, no crypto. These pages contain some of that. We're not going there. We're going to focus on the parts that matter for operators, allocators, and the long-term compounding of real economic capacity. So let's start with the labor market. Because labor is the heartbeat of the consumer economy, the Journal describes a reality that is brutal in its simplicity. The government dramatically lowered its estimates for how many jobs the economy generated over the past 2 years. Think about what that means. This is not a debate about forecasting. This is the scorekeeper walking back the scoreboard. The Bureau of Labor Statistics said the U.S. produced fewer jobs than previously estimated, both in the year that looked strong and in the year that looked merely okay. And what's fascinating is how the story explains the machinery behind the correction. On screen, you see a chart that makes the point visually. Job growth was throttled back in the revised data. The visual is doing something important. It is reminding you that the labor market is measured through a survey, a snapshot, and that snapshots drift. Then, once a year, the BLS benchmarks the estimates against a near-complete count based on state unemployment insurance records. That's the audit. That's the reconciliation. That's what accountants would call closing the books. And the revision was large. The story lays out 2 separate revisions, the annual benchmark revision and a tweak to the model that estimates how many businesses open and close each month, the so-called birth-death model. Now I want to translate that into investor language. This is a measurement system with 2 failure modes. 1. The sample you're surveying is not representative. 2. The model you use to fill in the missing parts becomes detached from the real economy. The article says the risks of sample errors have grown as employer response rates have declined. And it also says the model struggled with distortions in the aftermath of the pandemic. So what we're really seeing is the economy outgrowing the measuring tools. And when that happens, the narratives get sloppy. Operators make decisions in the fog. Investors allocate in the fog. Now, the on-screen visuals deepen the point. You see sector breakdowns for the most recent month. And the picture is not broad strength. It's concentration. The article notes job gains, but it also emphasizes that the strongest growth is in healthcare and social assistance. You can almost feel what that means at street level. A country can add jobs and still feel stagnant if the jobs aren't distributed across the kinds of industries that create broad wage growth and confidence. And then there's another piece of the reality check in the story. The labor market has been defined by companies holding off on new hires, but not slashing jobs en masse. That is a very specific labor regime. It creates a particular kind of pain. You don't see mass layoffs, but you also don't see opportunity. People get stuck. Young graduates struggle to get a foothold. The unemployed experience long, fruitless searches. That's not just a social story. That's a demand story. Because the consumer economy runs on paychecks. Now, the second half of our combined story. Energy. Because a modern economy is not only labor and capital, it's watts, it's pipes, it's infrastructure that nobody thinks about until it breaks. The Journal describes a winter cold snap that tested the nation's power grid. Grid operators and utilities managed tighter supplies and issued various alerts, but avoided rolling blackouts, so the system held. But it held by leaning on the old reliables. The article says the U.S. leaned on fossil fuels to get through the storm. In New England, natural gas generation and electricity imports make up a large share of power supply, and many plants can switch to oil when gas delivery gets constrained in extreme cold. The article notes that oil generated more than 1/3 of New England's electricity during the peak of the freeze. You can picture that, right? a region that talks about the future, surviving the present by burning what it already knows how to burn. And there's another on-screen visual earlier in the page that's easy to miss but important. A chart showing projected total federal debt as a share of GDP, sourced to the Congressional Budget Office. I'm not going political with this. I'm going operational. Debt projections are a reminder that the system has limited flexibility. When constraints pile up, aging infrastructure, climate volatility, energy transition costs, and higher interest burdens, capital allocation gets more competitive. Every dollar has more claimants. Every investment has a higher hurdle. Now, the most interesting operational detail in the grid story isn't the generation mix, it's where the weak point emerged. The article says the weak point was the usual spot, the smaller distribution lines and poles that carry electricity through cities and neighborhoods. This is such a classic infrastructure lesson. The bulk system can survive. The last mile is fragile. And that fragility has economic consequences. Outages, repair costs, insurance costs, political pressure, and regulatory demands. And then there's a detail that matters a lot for the next decade of investing. When wholesale power prices soared, some large flexible users powered down. But the article says data centers for cloud computing and artificial intelligence kept using electricity at a high and steady rate. That is the new baseload. Not factories alone, not homes alone. Compute is not seasonal in the same way. Compute is persistent, it's contractual, it's strategic. So what does that mean? It means we're moving into a world where the grid must be built for a different demand profile. Spikier weather events on one side, and steadier industrial-scale digital demand on the other. This is a capital allocation problem for utilities, regulators, and the companies financing generation and transmission. And it is a constraint problem for everyone who wants to build in the AI supply chain. Now let me tie the two stories together, the way a value investor should. The labor market story is about the reliability of the dashboard. The grid story is about the reliability of the engine. If your dashboard is wrong, you misjudge the cycle. If your engine is fragile, you misjudge capacity. And both mistakes destroy capital when they compound. So here are the lessons I pull from these pages. Timeless and useful. First, measurement is part of the moat. If a company can see reality earlier and more accurately, through better internal data, better demand sensing, better operational telemetry, it makes better decisions before the market does. Second, resilience is not a slogan, it's an asset. The grid didn't fail system-wide, but it revealed where the fragility lies: last-mile infrastructure and fuel constraints. The companies that invest ahead of the failure, hardening, redundancy, fuel optionality, avoid the expensive kind of learning. Third, the next decade's winners will be the ones who respect constraints. Not by stopping growth, by designing growth that fits the system, labor availability, energy availability, and the physical limits of infrastructure. And I want to end on one sentence you'll remember. Revisions teach humility, storms teach respect, but compounding belongs to the operators who plan as if both are guaranteed. Moving to next title, Revisions, Resilience, and the Rich Man's Balance Sheet. The economy is a story we tell ourselves in real time. And then the paperwork catches up. That's the through line across these Wall Street Journal pages. The difference between the headline reality and the balance sheet reality. One page is about the labor market getting revised. Less job growth than people thought. Another page is about a cold snap testing the power grid. Systems holding, but only by leaning hard on older fuel choices, and by exposing where fragility actually lives. And this new page adds a third lens. How the ultra-wealthy finance their lives, how they avoid selling, how they borrow, how they turn illiquid prestige assets into liquidity, and how banks compete to be the counterparty. No politics, no crypto, just incentives, capital allocation, and time. Because if you want to understand compounding, real compounding, you have to understand how decisions get made when the numbers are big enough to change behavior. Let's start with the labor market. The journal describes the government dramatically lowering its estimates for how many jobs were created over the prior 2 years. That's not a footnote. That's the official scorekeeper revising the scoreboard. And it matters because so many second-order decisions hang off this one variable. Hiring plans, wage budgets, rate expectations, consumer confidence, and the way investors price cyclicality. On screen, the visuals make the point in a way words can't. You see a chart about revisions, How reported monthly job changes were adjusted after the fact. You see sector bars that show where hiring actually came from. And when you stare at it, you realize something uncomfortable. The job market can look fine in aggregate while being narrow underneath, concentrated in specific categories, with white-collar areas looking much more mixed. That's an incentive story. Companies didn't fire en masse, but they also didn't hire broadly. They protected margins. They protected optionality. They waited. And waiting is a strategy when you don't trust the future. Now move to the power grid story, because it's the same theme. Systems under stress revealed by a test. A cold snap hits. Demand spikes. But the country avoids rolling blackouts. So you could call it a success. But the journal's details tell you what the success depended on. Fossil fuels did the heavy lifting, especially in New England where fuel switching, from gas to oil, becomes part of the survival toolkit when delivery constraints show up during extreme cold. Coal and gas generation surge while output from some renewables drops. And the weak point, this is the part every operator nods at, isn't the big flashy generation assets. It's the last mile, the smaller distribution lines and poles, the mundane infrastructure that carries electricity through neighborhoods. That's where outages happen. That's where the customer feels it. That's where the political pressure lands. And then there's the detail that ties directly into investing for the next decade: data centers. Even when wholesale power prices soar and some flexible users back off, data centers for cloud computing and artificial intelligence keep using electricity at a high, steady rate. That's a new kind of demand: steady, industrial scale, and not easily interrupted. A new baseload. So now you have two realities at once. Weather creates spikes, and compute creates a floor. That combination forces capital spending, transmission, generation, backup fuel. Redundancy. Not as ideology, as math. Now let's bring in the third story, the ultra-wealthy balance sheet. This page reads like a case study in how an allocator behaves when nearly everything is illiquid, appreciating, and tax-sensitive. The article describes how a billionaire couldn't get meaningful interest on a checking account when the Fed kept rates near zero after the financial crisis. Tiny yields, basically nothing. So the cash itself wasn't the engine. The engine was ownership. And the key point is this: founders of the biggest private equity firms seldom sell their shares. They hang on. It's a vote of confidence. And it's also about taxes. Selling long-held stock can trigger large capital gains taxes. So instead of selling, they borrow. This is where incentives become almost mechanical. If your wealth is concentrated in a stake you don't want to sell, and you want liquidity without taxes, you use debt as a bridge. Not because debt is good, but because debt is cheaper than the tax bill, and it preserves control. The article goes deeper into how this works in practice. It describes a large loan backed by an extensive art collection, secured by works from major artists. It describes collecting at a scale where paintings, rare books, and historical artifacts become both status goods and balance sheet collateral. And then it lands on the truly important idea for investors. Banks compete aggressively to lend to important customers, offering rock-bottom rates and even proposing additional lending backed by a mix of art and concentrated equity holdings. So what is the capital allocation lesson? It's that liquidity is not just cash. Liquidity is the ability to turn what you own into spending power without selling it. And that is a different game entirely. The wealthy are not playing save and spend. They are playing own, borrow, and hold. And when you see that clearly, you start to understand why certain assets inflate, why certain institutions fight for these relationships, and why the incentives around leverage can quietly build systemic risk in places the average person never notices. Now I want to stitch the three threads together. First, measurement risk. The job market can be misread in real time, and revisions can invert the confidence people had. Second, infrastructure risk. The grid can hold, but only by revealing its weakest links and its reliance on fallback options. Third, financing asymmetry. At the top of the pyramid, the cost of capital is different, the tax constraints are different, and the choice set is different. Same economy, different physics. So here are the lessons I take, in the language of operators and long-term compounding. 1. The best allocators don't just look at outcomes, they look at the reliability of the instrument panel. If the data can be revised dramatically, you demand wider margins of safety in your decisions. 2. Resilience is a form of return. Money spent hardening systems looks like a cost until the day it prevents a catastrophe. Then it becomes the highest ROI decision in the entire budget. 3. Control is the hidden asset. Moving to next title, When Diligence Fails, Private Credit's Blind Spot and the Price of Trust. Trust is an asset. And in markets, trust doesn't just sit there. Trust gets leveraged. Trust gets packaged. Trust gets sold. And when trust fails, it doesn't fail like a stock missing earnings. It fails like a floor giving way under your feet. Sudden, total, and humiliating. That's the center of gravity in these Wall Street Journal pages. I'm going to stay disciplined. No politics, no crypto. One of the pages you uploaded is dominated by geopolitics and conflict. We're not touching it. Instead, I'm going to focus on the business and investing material that's here. Because it's rich, it's cautionary, and it's exactly the kind of case study that teaches investors how incentives really work. The big story is this. A BlackRock unit, through HPS, a major private credit firm it acquired, got duped into a loan tied to allegedly fraudulent collateral. And the reason that matters isn't the single loss. The reason it matters is what it says about the private credit machine, about competition, about growth pressure, about diligence theater, and about the one thing private credit sells more than yield, the promise of control and information. So let's walk it like operators. The central figures here are the builders of HPS and the borrower at the center of the alleged fraud. HPS was founded in 2007 by Scott Kapnick, Scott French, and Michael Patterson, former Goldman Sachs bankers who left to build what became one of the gold standard private credit firms. By late 2024, the journal says, their reputation reached a zenith. They were drawing takeover interest. They debated going public versus selling to a bigger firm. And when their sale to BlackRock closed, the three co-founders were minted billionaires. That's the what worked for a long time section of the story. Build a reputation. Scale assets. Become a trusted allocator for pensions and insurance firms. Become the kind of institution that can sell certainty in an uncertain world. Now the constraint, what quietly stopped working, is embedded in the way the industry grew. The journal points to the rise of private credit, direct loans made by private funds rather than traditional banks. That growth has a shadow, intense competition among lenders. And in intense competition, winning deals can mean taking greater risks, not always overtly. Sometimes it's subtler. You don't say, let's do worse diligence. You say, we can move faster. You say, we have third-party checks. You say, the collateral is good. You say, our process is comprehensive. And then, one day you find out the process was comprehensive in the way a checklist is comprehensive. Complete, but not alive. Now meet the borrower described in the article. A man named Brahmpat, age 57. The journal says he entered the telecom industry in India in the 1980s, and by the early 2000s brought his business to the US, establishing offices in Long Island and Queens. His companies engaged in wholesale VoIP termination, routing large volumes of phone calls to the correct destination over the internet. Then, by the late 2010s, he started a company called Carriox. Carriox claimed to engage in factoring, buying accounts receivable, the yet-to-be-paid invoices at a discount. This is where the business model matters. Factoring is a financing business disguised as an operations business. It lives and dies on documentation, on who really owes what, on whether invoices are real, on whether counterparties exist, and most importantly, on whether the lender's verification is independent or performative. Now we get to the inflection point, the deal-making frenzy. The journal says HPS's dealings with Brahmpat came as private lending was being turbocharged in the early 2020s. And it quotes Daniel Zwirn, CEO of alternative credit firm Arena Investors, saying investors' guard was at its lowest, price competition was fiercest, and growth rates at the biggest firms were highest, the perfect setup for the worst combination of risk and reward. That's a system statement. That's what happens when an asset class becomes a destination for too much money chasing too few safe deals. Now, let's do the capital allocation autopsy. Decision number 1. HPS extends and then expands financing. The journal says Brahmpat approached HPS in 2020, seeking to refinance a loan he initially secured from a private lender. HPS's lawsuit says its investment team conducted comprehensive due diligence during the initial financing. HPS also relied on third-party experts, including Deloitte, for assurances, according to people familiar with the matter. Then the facility grows. HPS offers a large credit facility that provides cash while the companies wait to collect on invoices. And with help from BNP Paribas, the investment grows to around $440 million. What was expected? That invoice collateral is real, that audits validate it, that counterparties confirm it, that the system works. What actually happened, according to the journal's account, is that the lender ultimately discovered it had been duped. And the way it discovered it is the part that makes your stomach drop if you've ever underwritten anything. The journal says HPS hired CBiz to perform ongoing annual audits of collateral. Then, this summer, HPS asked CBiz for the underlying communications used to validate the invoices. As responses came in from firms that were purported to be business partners, an HPS analyst noticed fake email domains. That's the tell. The fake domains. The subtle difference in spelling, in suffix, in the digital fingerprint of the counterparty. HPS's lawyers contacted the actual firms and confirmed the lender had been duped. A security staffer at Belgian telecom company Bix wrote back with the words that end careers. This is indeed a confirmed fraud attempt. Now, step back. What's the opportunity cost here? It's not just the principal at risk. It's the reputational capital. Private credit is built on the idea that you're closer to the borrower than public markets are, that you have covenants, that you have information rights, that you can protect yourself. If you can be fooled at the invoice collateral level, at the foundation of asset-backed comfort, then the perceived safety premium collapses. And the journal asks the questions the market immediately asks. How could one of the most sophisticated private lending firms in the world be duped? Why didn't anyone spot it before BlackRock sealed the deal with HPS? Could similar frauds be lurking in the private lending industry? Those aren't rhetorical. They're the start of a new underwriting regime. Now, the article also says the borrower's firms filed for bankruptcy, and HPS has told clients it isn't clear what money will be recovered. And it says the FBI is probing Bromhat, so the event isn't contained inside a spreadsheet. It moves into legal systems, into investigations, into recoveries that can take years. That's the time dimension investors often underestimate. In private credit, time is not neutral. Time changes recoveries. Time changes narratives. Now, I want to integrate the other thread on this page, Kraft Heinz, because it's a very different story, but it shares one theme. When an institution hits complexity, it starts searching for simplification. The journal describes comments from the new CEO, Steve Cahillane, about Kraft Heinz's planned breakup and how the company might ultimately decide not to break up at all. He talks about getting back to price points that are more friendly to consumers, and he says the board reserves the right to get smarter. That line, get smarter, is the honest version of strategic flexibility. It's management admitting that plans are contingent and that feedback matters. And it's a useful contrast. In the HPS story, the feedback came late and violently fraud discovered after years, after upsizes, after institutional momentum. In the Kraft Heinz story, the feedback is being invited earlier, reconsidering structure, reconsidering pricing, trying to earn the right to price. Different industries. Same question. Are you learning fast enough? Now, the reality check. What I want you to feel in your bones as an investor. Private credit has been sold as a safer way to earn yield, but safety comes from process. And process can decay when growth becomes the goal. When reputation becomes a substitute for skepticism. When third-party assurances become a substitute for direct verification. When audits become routine, when nobody wants to be the person who slows the deal down. Because the incentives don't reward the person who prevents a bad deal, they reward the person who closes the deal. Until the day they don't. So here are the timeless lessons. First, in lending, collateral is only as real as your ability to independently verify it. If verification depends on channels the borrower can spoof, you don't have collateral, you have a story. Second, success carried too far creates blind spots. When a firm becomes gold standard, it can start believing its own marketing, and the system around it stops asking hard questions. Third, competition compresses diligence. In a deal frenzy, speed becomes a feature, and speed is the enemy of truth. Now I'll end with conviction, because the article forces it. The core question is, what is private credit really selling? It sells yield, yes. But more than that, it sells the promise that you're not blind. This story is what happens when the promise breaks. And here's the one sentence I'd want a serious investor to remember for years. In private credit, the biggest risk isn't volatility, It's misplaced trust compounded by speed. Moving to next title, Systems Under Stress. Revised jobs, a winter-tested grid, and private credit's trust problem. Trust is a balance sheet item, not in the accounting sense, in the real-world sense. It's an asset that lets you do things other people can't do. Move faster, write bigger checks, win better terms, charge for certainty. And then, sometimes, trust becomes the very thing that blinds you. Because once the market decides your gold standard, you start living off reputation, and the process underneath can quietly thin out. This is from the Wall Street Journal, and today I want to stay inside the lane of business and investing. No politics, no crypto, no sensational detours. Just incentives, underwriting, capital allocation, and the long shadow of compounding. Because the story sitting in front of us is not just about one bad loan. It's about what happens when an entire asset class grows so quickly that diligence becomes a performance. And when diligence becomes a performance, fraud doesn't need to be brilliant. It just needs to be plausible. The central institution here is HPS, a private credit firm founded in 2007 by three former Goldman Sachs bankers, Scott Kapnick, Scott French, and Michael Patterson. Builders, operators, people who didn't just participate in a trend. They wrote it, shaped it, and scaled it. The Journal says that by late 2024, HPS's reputation had reached its zenith. They were drawing takeover interest. They debated going public or selling, and then they sold $12 billion to BlackRock. And when that deal closed, all three co-founders were officially minted billionaires. Now, that is the what worked for a long time section. Build a track record, build a brand, build distribution, build assets under management. And when the time is right, sell that trust to the largest allocator in the world. But every compounding machine has a failure mode. And in credit, the failure mode is always the same. Not the borrower missed a quarter, not a recession hit. The true failure mode is, you thought you had control, and you didn't. You thought you had visibility, and you didn't. You thought the collateral was real, and it wasn't. The borrower in this case is described as Brahmpat, 57 years old. The Journal says he entered telecom in 1980s India, and by the early 2000s brought his business to the US, establishing offices in Long Island and Queens. His companies engaged in wholesale VoIP termination, routing high volumes of phone calls to the correct destination over the internet. Then, by the late 2010s, he started a company called Carriox. Carriox claimed to do factoring, buying accounts receivable, invoices that haven't been paid yet, from companies at a discount. I want to stop right there. Factoring is not a tech story. It's not a telecom story. It's a verification story. It's a counterparty story. Your entire risk framework depends on whether invoices are real, whether customers are real, whether the amounts are real, whether the terms are real, and whether the cash ultimately arrives. And because the underlying assets are pieces of information, documents, emails, confirmations, this is exactly the kind of business where an auditor's process can either protect you or expose you. Now, let's talk about scale, because the Journal gives you the scale, and then it gives you the punchline. The loss on the Brahmpat loans is a tiny fraction of HPS's $179 billion in assets under management. But it had a substantial impact on the two main funds that held it. That's important because in private credit, investors don't own the firm. They own exposure to specific pools of risk, so a single blow-up can be immaterial to the brand and very material to the client. And a client doesn't care that the platform is huge, they care that their sleeve got hit. Now, here's the inflection point. The deal frenzy. The Journal says HPS's dealings with Brahmpat came as private lending was being turbocharged in the early 2020s. It quotes Daniel Zwirn, CEO of Arena Investors, describing the setup. Investors' guard was low. Price competition was fierce. Growth rates at the biggest firms were high. And that combination was the perfect setup for the worst mix of risk and reward. That is the cycle. The more money rushes into an asset class, the more standards slip. Not because people want to be reckless, because the incentive is to keep deploying. And if you don't deploy, you don't earn fees. If you don't earn fees, you don't grow. And if you don't grow, you fall behind the firms that do. Now we do the capital allocation autopsy. Decision 1. HPS enters the relationship. The Journal says Brahmpat first approached HPS in 2020, seeking to refinance a loan he initially secured from a Dallas-based private lender. Crestline investors. HPS's lawsuit says its team conducted comprehensive due diligence during the initial financing. They also relied on third-party experts, including Deloitte, for assurances. And by the end of 2020, HPS offered a large credit facility, cash up front while the companies waited to collect invoices. Then, HPS upsized the facility twice. And with help from BNP Paribas, the investment grew to around $440 million. This is how it happens. It never starts as a disaster. It starts as a relationship. Then, a renewal. Then, an upsizing. Then, we know this borrower. Then, we've seen the collateral. Then, we have audits. Then, we can scale. Until the day you can't. Now, here's the moment where process meets reality. The Journal says HPS hired CBIZ to perform ongoing annual audits of collateral supplied by Brompot. Then, this summer, HPS for the first time asked CBIZ to provide the underlying communications it used to validate the invoices that served as collateral. And as responses came in from companies that were purportedly business partners, an HPS analyst noticed fake email domains. That detail is everything, because it suggests a horrifying possibility that for years verification may have been happening through channels that could be spoofed. And once you allow verification to flow through a channel the counterparty controls, you're not verifying. You're participating. HPS's lawyers contacted the actual firms and quickly confirmed the lender had been duped. A security staffer at Belgian telecom company Bix replied with a sentence that ends the debate. This was a confirmed fraud attempt. And then the story tightens. HPS lawyers said a review of contracts Brompot provided. Auditors revealed what appeared to be forged customer signatures. Then HPS seeks answers. Brompot had been in India since June, he later told a judge in bankruptcy court. In calls with an HPS portfolio manager, he said he would get to the bottom of invoice discrepancies. And then, according to HPS, he stopped picking up the phone. On Aug 4, lenders visited his corporate offices in Garden City, New York, and found them locked and empty. Now we're in the part of the story that private credit marketing doesn't talk about. Recovery. Enforcement. Chasing ghosts. The Journal says Brompot's firms filed for bankruptcy in August. HPS told clients, including pensions and insurance firms, it isn't clear what money will be recovered, and the FBI is probing Brompot. This is where time becomes the hidden cost. A fraud doesn't just create a loss, it creates years of distraction. Legal fees, reputational damage, client conversations, regulator conversations, investor redemptions, maybe. And the bigger the platform, the bigger the question becomes. What else is sitting in the portfolio that hasn't been stress-tested by reality yet? The Journal also says a review of the borrower's background revealed details that diligence experts said should have set off alarms. One of Brompot's companies had its utility status suspended by Pennsylvania in 2017 after a commission review described an unacceptable history of compliance. And in multiple lawsuits filed in 2018 or earlier, plaintiffs alleged Brompot or his companies used services and refused to pay. One plaintiff said the company had less revenue than it claimed. Those cases ended in settlements or moved to arbitration. Now, I'm not here to litigate guilt. I'm here to litigate incentives. Because the point is, the signals existed. The question is whether anyone was rewarded for treating those signals as disqualifying, or whether the system rewarded deploying capital anyway. The Journal says HPS told investors last year it wrote the entire investment down to zero, to be conservative. That's the accounting end state. But the investing end state is the lesson. Once the trust breaks, you don't get to adjust it. You mark it to reality. Now, I want to contrast this with the other business story that sits on the same page, Kraft Heinz. Why? Because it's another case study in what grown-up capital allocation looks like when complexity gets too high. Kraft Heinz had unveiled a breakup plan, estimating related costs up to $300 million. Since then, it parted ways with its former CEO, Carlos Abrams Rivera. It recruited Steve Cahillane, who previously led Kellogg, and oversaw its split that created two companies, both later acquired. And now Cahillane is essentially saying, we might not break up at all. He says food companies need to earn the prices they charge, and that Kraft Heinz's recent price increases didn't coincide with benefits for consumers. He believes they can get back to more consumer-friendly price points quickly. He talks about getting smarter, with the board telling him everything should be on the table. He says Kraft Heinz has historically underinvested in brands, and that it needs to spend more on marketing, sales, R&D, hundreds of millions to fuel a recovery. He points to innovation being stunted by underinvestment, and he describes a new product example, a Kraft mac and cheese variant positioned as higher protein and fiber. He says the company is too lean and wants to hire more sales and marketing people and raise marketing spend to a mid-single-digit percentage of net sales. And Berkshire Hathaway, Kraft Heinz's biggest stockholder, approves of putting the breakup on hold. Now, why does that matter in the same episode as the private credit fraud story? Because it shows two different ways organizations respond to pressure. In private credit, pressure often shows up as a demand to deploy capital and grow AUM. In consumer staples, pressure shows up as market share loss and consumer pushback on pricing. In one case, the danger is that speed and scale dilute verification. In the other, the danger is that cost-cutting and price increases hollow out brand equity. Both are versions of the same sin. Success carried too far. The private credit version is reputation carried too far. The consumer staples version is efficiency carried too far. So here's the reality check. The part we should not soften. Reputation lags reality. It always does. That's why it's valuable. If you can't independently validate collateral, you don't have a margin of safety. Lesson 2. Growth pressure is a silent underwriter. It changes what acceptable looks like inside institutions without anyone writing it down. Lesson 3. The best capital allocators build feedback loops that surface problems early. Cahalan is trying to create earlier feedback in pricing, innovation, and brand investment. HPS discovered the fraud only when someone asked for underlying communications and noticed fake domains. That's a feedback loop too, but it arrived late. And I'll end with conviction, because this is the sentence the market needs to remember. In a boom, the biggest risk isn't the deal you lose, it's the deal you win without truly knowing what you bought. Moving to next title, Pricing Power Meets Reality. Beer demand, medical cost inflation, and the creator economy's new capital. Volume is truth. Price is negotiation. And in every business I respect, the long run is a constant argument between those two forces, between what the customer will actually consume and what the company can actually charge. That's the pattern running through these pages of the Wall Street Journal. You've got a global brewer facing weak demand and turning to restructuring. You've got a health insurer staring at rising medical costs and a hit to earnings power because of Medicare quality ratings. And you've got a content company built by an old-school entertainment operator raising private equity money to go hunting in the creator economy, trying to turn social media attention into durable TV and streaming IP. Three different worlds. One shared question. What's real? What's durable? What compounds? Let's start with the brewer, because beer is one of the cleanest demand signals in consumer staples. Heineken plans to cut up to 6,000 jobs, up to 7% of its global workforce over the next 2 years. They're not doing this because they woke up and felt like getting efficient. They're doing it because the market is weak. The journal says they're contending with higher costs and weaker demand, with consumers curbing spending and becoming more health conscious. Now watch how the math expresses it. Heineken did what many mature consumer companies do when the engine slows. It pulled the two levers it can control: pricing discipline and cost structure. The journal says revenue growth for the year was achieved through higher prices, though not in all markets. And you can hear the operator's instinct in the CEO quote, concerned about affordability, trying not to put too much pressure through pricing, trying to find the right balance. That's not just PR. That's the psychology of the demand curve. When you push pricing too far in a weak demand environment, you don't just lose volume, you train customers to switch. You train them to downgrade. And in beer, where switching costs are low and private label exists in many markets, habit is the moat. So Heineken is threading a needle. Protect the P&L without damaging the habit loop. The restructuring includes closing some breweries outside Europe and merging teams in smaller markets. That's a capital allocation decision. It's management admitting certain nodes in the network no longer earn their keep. Now layer in the forward guidance. The journal says Heineken guided to weaker profit growth in the year ahead. Operating profit expected to grow 2% to 6% versus a prior forecast of 4% to 8%. That's not catastrophic, but it's a deceleration. And deceleration forces honesty. The world of easy pricing is over when the consumer pushes back and health trends cut at the category. Now, I want you to visualize what's on screen for this Heineken story. You see a photo tied to the idea that consumers are curbing spending. That's the subtle message. This isn't a company-specific story only. It's macro pressure hitting everyday behavior. But investors don't get paid for noticing macro pressure. They get paid for noticing who can adapt without breaking their brand economics. Now we pivot to Humana. And this is a different beast, because health insurance isn't selling a discretionary product. It's selling risk pooling. It's selling a promise. And the enemy here isn't weaker beer demand. The enemy is cost inflation and utilization. The journal says Humana reported a wider fourth-quarter loss as medical costs continue to rise and expects a sharp decline in 2026 earnings due to lower quality ratings of its Medicare plans. Read that again. Rising costs, lower quality ratings. Those two together are a compounding problem. The company reported a large quarterly loss. Revenue rose, but the benefit ratio, the proportion of premiums paid to cover medical costs, rose as well. That ratio is your heartbeat metric. When it moves the wrong way, it tells you the insurer is paying out more of each premium dollar. And the journal explains the drivers: more utilization of medical services, higher pharmaceutical costs, older people, in particular, using services more. And because Humana relies heavily on Medicare Advantage, it gets hit harder than some peers. That's business model concentration showing up as fragility. Here's the uncomfortable truth for investors. In health insurance, growth can be toxic if you're growing into a pool where costs are accelerating faster than your pricing and reimbursement mechanisms. If you can't align incentives, patients, providers, pharmacy benefit structures, regulators, you don't have a compounding machine. You have a treadmill. And treadmills don't compound. They exhaust. Now, let's go to the third thread: propagate content and Aries. This is in technology and media, but it's really a capital allocation story about where attention is moving and how money follows attention. The journal describes an effort led by entertainment executive Ben Silverman, through propagate content, to add more social media creators and influencers to the company's roster. Distribution first, audience first, then adaptation. Now the money. Aries management made a new $50 million investment, and the journal says it values Propagate at more than $200 million, up 33% from its prior valuation in $23,000. Propagate is profitable, and about half of its revenue comes from management businesses, with the other half coming from producing operations. This is a very specific model. It's not bet the farm on one show. It's a portfolio. Management fees and participation on the talent side, production economics on the content side. And then a land grab in creators, because creators are the upstream of demand now. Silverman's quote matters: working with creators to translate their content into television shows. Translation is the business. And translation is where moats can form, because creators can create, but not all creators can build durable franchises, negotiate distribution, structure deals, protect upside, manage churn, and keep output consistent. That's what an operator like Silverman is selling. Not ideas, process and packaging. Now, on the same page, you also see a few watch items: NetEase, Nexperia, T-Mobile, Cisco. And as an investor, you should read these not as headlines, but as signals about the environment. NetEase shows profit down year over year while it talks about improving production efficiency with the help of AI. Nexperia is dealing with governance and management allegations, with a court-ordered probe and a suspended CEO. T-Mobile added fewer subscribers than expected, while revenue rose and profit was pressured by severance costs. And Cisco, this one is pure operator economics, posted revenue growth and solid earnings, but gross margin fell and is expected to keep sliding, with the CFO pointing to climbing memory prices and rising purchase commitments. Memory prices. That is supply chain economics biting into the AI build-out. Not in theory, in gross margin. So what's the shared pattern across all of this? In consumer staples, price can carry you only so far when volume is falling. In insurance, revenue growth is meaningless if the benefit ratio is worsening and quality metrics pressure earnings power. In media, attention is migrating and capital is trying to professionalize the messy creator world into something that can be packaged, financed, and scaled. And in enterprise tech, the AI cycle isn't free. It tightens component markets and pushes costs into margins. Now, the lessons. 3 timeless ones. First, when volume falls, cost structure becomes strategy. Heineken is choosing to reshape the business rather than pretend the old demand environment is coming back. Second, in regulated risk pools, incentives are the product. If the incentives don't align, utilization, reimbursement, quality ratings, earnings power is not stable. Third, the next generation of media franchises will be manufactured upstream, at the level of audience, not at the level of production. The operator advantage is the ability to turn attention into durable economics without being held hostage by the platform that produced the attention. And I'll end with one sentence I want you to keep for years. Compounding doesn't come from raising prices. It comes from earning loyalty while your costs, your incentives, and your distribution all evolve. Moving to next title, buybacks, bids, and 100, year money, capital allocation under pressure. There are two kinds of executives. The first kind uses capital allocation to express confidence. Buybacks, dividends, longer duration debt. The second kind uses capital allocation to buy time, cut costs, slow buybacks, restructure contracts, sell trophy assets, renegotiate the covenant you didn't realize you signed with your shareholders. These Wall Street Journal pages are really about that split, not the headlines, not the chatter, the decisions. Because when the environment changes, prices fall, costs rise, technology shifts, the company reveals itself through the check it writes and the check it refuses to write. No politics, no crypto, just incentives and compounding. Let's start in energy, with Total Energies, because oil majors are always running the same playbook, until they can't. The Journal says Total Energies will reduce stock buybacks and step up cost savings after lower oil prices hit its fourth quarter results. On screen, what you see is the classic corporate pivot, a company that has been a steady buyer of its own stock, dialing the program back to retain flexibility. They're halving the quarterly buyback to $750 million, and they're framing the full-year repurchase plan as a range between $3 billion and $6 billion versus $7.5 billion last year. That range is management telling you, quietly, we don't know the tape yet. And they're pairing that with a cost program. Total Energies now targets $12.5 billion of savings over the 2026 to 2030 period, including $2.5 billion this year. The Journal notes that in September the program was smaller, $7.5 billion over the same time frame. So the savings target moved. That's not just belt tightening. That's a reset in assumptions. And notice the industry comparison baked into the story. BP suspends its buyback as part of a plan to cut high net debt. Exxon and Shell say they aim to keep buying back stock at the same pace. That divergence matters. It tells you different balance sheets, different confidence levels, different internal break-evens, and different tolerance for volatility. Now zoom into the operating results the Journal gives you. Total Energies' net profit fell versus the prior quarter, coming in below analysts' expectations. Upstream earnings declined, but integrated LNG got a boost from the restart of the Ichthys plant in Australia, even as prices declined. Downstream earnings jumped on higher European refining margins. So you're watching an integrated major do what it's built to do. Let one segment offset another. That's the business quality argument for integration. But integration doesn't save you from the capital cycle. It only smooths it. And then, crucially, the company declares a final dividend, increasing the full-year payout. This is the tightrope: slow buybacks to preserve flexibility, but keep dividends rising to signal stability. That is incentives management. Dividends are a promise. Buybacks are an option. When times get murkier, options shrink first. Promises stay until they can't. Then Total Energies lays out the forward spend. They expect to invest around $15 billion over 2026, including about $3 billion mainly for electricity. Production guidance shows oil and gas rising modestly, electricity growing faster. This is the energy transition expressed as capital budgeting, not speeches. Now let's shift to semiconductors, because here the constraint isn't oil prices, it's components, it's memory. The Journal quotes the co-CEO of SMIC, China's largest contract chip maker, saying the industry is a bit panicked about a memory chip shortage driven by the AI boom. You can almost hear the truth inside that phrase. Panic isn't about long-term fundamentals. Panic is about short-term supply and commitments. Memory prices have soared, up 80% to 90% from late last year, according to the Journal's cited market researcher data. And the reason is simple. The three companies that make more than 90% of memory chips can't satisfy AI demand while still supplying PCs and smartphones. That spills into everything downstream. Device makers face higher component costs at the same time consumers are weaker. Foundries see lower-end makers reduce orders. And then you get the human behavior that always appears in crunches. Overbooking. Everyone tries to lock in supply, which makes the shortage look worse. SMIC's CEO suggests more supply could come in about 9 months, and he also notes that some new supply could reach consumer electronics first because AI-related memory, like high-bandwidth memory, requires longer, more complex verification. That's a subtle but important operator detail. Not all supply is fungible, and time to qualify becomes a competitive weapon. Now, step into the bond market and big tech, because this is where the compounding narrative gets dangerously seductive. One of the pieces here walks through how Alphabet's long-dated borrowing should be thought about, less as a 100-year bet, and more as a duration and cash flow math problem. On screen, you're essentially being asked to picture the bond's cash flows as a long stream of interest payments, with the principal repayment far out on the horizon and small in present value terms. And the article makes the key point. Investors should worry less about whether the world exists in a century, and more about whether Alphabet's heavy AI spending pays off well before then. But there's a second layer that matters even more. The journal highlights the borrowing to come. Big tech pouring cash into AI and data centers, raising hundreds of billions of dollars in debt. That changes the nature of these companies, from capital-light software toward capital-heavy infrastructure providers. And that tests lenders. Right now, the market is happy to finance it. Oversubscribed issuance. Tight spreads. Plenty of appetite. But appetite is cyclical, and if leverage rises across the sector, the limiting factor becomes not engineering talent, but the bond market's willingness to keep writing cheap checks. That's not a tech story, that's a capital story. Now we move to media, where the capital allocation is not capex, it's acquisitions, it's bids, it's termination fees, it's who gets to own the library and the distribution. The journal describes a battle for Warner Brothers. Discovery. Netflix has an all-cash transaction valued at $72 billion to buy Warner's movie and TV studios and the HBO Max streaming service. Paramount, led by CEO David Ellison, sweetens an all-cash offer for the entire company, $77.9 billion, trying to pull Warner back to the table and away from Netflix. Paramount's move is tactical. It offers to pay the $2.8 billion termination fee Warner would owe Netflix if the deal collapses, and it offers a ticking fee to Warner shareholders, 25 cents a share for each quarter the deal hasn't closed, starting in January 2027. That ticking fee is interesting. It's a way to price time, to turn regulatory delay into compensation. It's a way to say, if you're going to be stuck waiting, you should get paid for waiting. That's financial engineering, yes, but it's also a real insight into incentives. Warner's board has to decide whether to risk certainty for a higher headline number, or hold the line because the contract with Netflix makes reopening talks a high bar. And you see the metagame. Paramount is testing Netflix's pain threshold without constraining its own balance sheet too much, at least not yet. Now, in the same pages, you also have a real asset story that's pure long-cycle capital allocation. The Waldorf Astoria. A Chinese reinsurance firm bought the 400-room Waldorf in 2014 for $1.95 billion, and owners spent more than $2 billion on top of that. Now it's up for sale again, with an expected billion-dollar-plus price tag. The seller doesn't expect to get all its costs back. That's the trophy asset lesson that repeats forever. You can overpay for prestige, and then spend enormous sums making it perfect, and still discover that exit prices are set by the marginal buyer, not by your sunk cost. The journal notes potential buyers could include Middle Eastern and Asian sovereign funds and other foreign governments, and it frames the sale as part of a wave of Chinese property owners pulling out of the U.S. market. This isn't about buildings. It's about who wants their capital where and under what geopolitical and regulatory friction. I'm not going political, I'm going incentive. Capital wants safety, status, and enforceable rights. When any of those get questioned, capital moves. Finally, buried in the same spread is a bankruptcy notice, Xinex, and I'm going to treat it like what it is, a document of incentives and power. It lays out a Chapter 11 plan process, disclosure statement, confirmation hearing, voting record date, voting deadline, objection deadlines. It warns counterparties about assumption and rejection of executory contracts and unexpired leases, and it highlights release, exculpation, discharge, and injunction provisions. This is the legal system's version of capital allocation. It's how claims get prioritized. It's how equity gets canceled or survives. It's how old promises get rewritten into new securities. And here's the thing value investors sometimes forget. Bankruptcy is not just distress. Bankruptcy is governance. It's the moment the spreadsheet becomes enforceable reality. Now let's do the reality check across all of it. Total Energies is slowing buybacks because flexibility is worth more in a weaker price tape than optics are. SMIC is describing panic because supply chains don't care about narratives. Alphabet's long-dated money works until leverage and capex intensity change the credit story. Warner's bidders are pricing not only the asset, but the regulatory time path, using ticking fees and termination fees like chess pieces. And the Waldorf reminds you that real assets can be the least liquid expression of ego. So the lessons: 3. Clean, timeless. 1. Buybacks are a mood ring. When they get cut, management is telling you the cycle is tightening, even if the press release sounds calm. 2. In technology, the bottleneck is usually not the idea, it's the input. Memory, power, verification, supply commitments. That's where margins get decided. 3. In mergers, the price is never just the price. It's the price plus time, plus breakup costs, plus the probability-weighted path through regulators. And I'll end with the one sentence that matters most here. Compounding doesn't come from confidence. It comes from flexibility when the cycle turns. Now, towards last article, off-balance sheet, AI, Europe's energy trap, and the moment obvious trades break. Meta's auditor did something that should make every serious investor sit up straighter. It flagged a single, specific, marquee transaction as a critical audit matter. Not boilerplate, a warning label that says, this judgment was hard, risky, and important enough that we're calling it out. And the transaction is the kind that defines this era. An AI data center project, financed with enormous debt, structured so it doesn't sit on the company's balance sheet. This is from the Wall Street Journal. And today I want to connect 3 threads on the page that look separate but are actually the same story. 1. Europe's imported energy dependency. 2. The market's habit of crowding into the obvious trade until it breaks. 3. Meta's off-balance sheet data center financing, how capital allocation can become accounting design, and how accounting design becomes a risk signal. No politics, no crypto, just incentives and compounding. Let's start with Europe, because energy is the physical substrate of every other business model. Europe has to break its imported energy habit. That's the thesis. And the journal backs it with a clean, visual fact. America's share of the EU's LNG imports jumped to 60% in the third quarter of last year, from 28% in the same period of 2021. On screen, you can picture the chart, a stacked share breakdown of EU LNG imports by source: US, Algeria, Qatar, Nigeria, Russia, moving over time. And the message is simple. Dependency shifted. It didn't disappear. And then the comparison that matters. China and India, also huge importers, get meaningfully lower shares of their energy needs from imports, based on IEA data. Here's the operator lens. The EU is trying to run advanced manufacturing and a modern services economy with structurally higher vulnerability to external supply shocks. And vulnerability is not abstract. The column walks through recent bite marks. Russia turned off pipeline gas flows soon after the Ukraine war began in 2002, causing a major crisis. Europe spent the equivalent of 3.8% of GDP on energy imports in 2002 after prices spiked, using European Commission data. Then there's the deeper point. Energy gets used as leverage. Europe's dependence on imports became a bargaining chip, and even if you strip out the political dimension entirely, the economic dimension remains. Europe needs to lower energy bills to protect domestic industry. The European Commission's competitiveness assessment says businesses in Europe pay twice as much for electricity as they would in the US. That's not a temporary annoyance, that's a structural tax on industry. So the capital allocation answer in the piece is domestic generation. Homemade electricity, more solar and wind, reduces the region's exposure to the price roller coaster. The column says the EU reached a major tipping point. Last year, wind and solar generated more electricity than fossil fuels for the first time in Europe. And the on-screen evidence continues. You hear about a mammoth offshore wind farm planned in the North Sea, up to 100 gigawatts of offshore wind. It's an industrial project at continental scale. That's what breaking dependency looks like. But then you hit the constraint. Supply chain dependency shifts. If Europe produces more solar and wind at home, it will order most of the equipment from China, described as the world's factory for clean energy technology. So Europe is forced into a choice between dependencies, not in a philosophical sense, in a practical procurement sense. And that brings us to the broader investing pattern on the same page. When obvious trades stumble, look for bargains. Spencer Jacobs' column is really about crowding, about the market's reflex to pile into what's been working, about how the easiest trade becomes the most dangerous trade. Not because it's wrong, but because it gets priced as if it can't fail. He points to last Friday being the strongest day for U.S. stocks in months, a relief for investors riding the AI-inspired bull market. And he describes the reflex. After tumult, go right back to the winners. But then he reminds you what actually happens in cycles. Overlooked stocks get rediscovered after violent sell-offs and degrossing by big funds. Selling winners, covering shorts, can catalyze a rotation. He uses the COVID trade as a case study. At-home winners surged. Travel and leisure got crushed. Then vaccine news flipped the trade violently. The winners never recovered. The losers became great buying opportunities. It's a clean behavioral template. What feels safest at the top becomes toxic on the turn. Now he pulls the lens back to AI. Yes, large U.S. companies exposed to AI are profitable and fast-growing and desirable, just not at any price. And here's the on-screen chart that matters. The performance of the S&P 500 versus an equal-weighted S&P 500 during the tech bubble episode and during the ChatGPT episode. You can picture it. Two lines separating. One representing the cap-weighted index dominated by giants, the other representing equal weight where smaller constituents matter. From the introduction of ChatGPT in November 2022 through the end of last year, the equal weight index trailed by 41 percentage points. Jacob compares that to the late 1990s tech bubble period, where the lag was 49 points over a similar time length. Then he makes it actionable. The equal weight index is off to one of its best starts in decades, as stodgy stocks get rediscovered. And he cites a valuation tool from research affiliates that estimates if valuations revert to average from end of January levels, U.S. large growth might return just 1.4% annually over the next decade, while small caps and non-U.S. developed value look meaningfully higher. Now, I'm not going to turn this into a buy this basket pitch. I'm going to turn it into the real lesson. Valuation is gravity. Narrative can fight gravity for a while, but gravity always collects. And now we arrive at the third thread, the one that ties energy dependency and trade crowding together with corporate finance, Meta. The Journal says Meta's latest annual report contained an unusual cautionary note. Ernst & Young raised a red flag over financial engineering Meta used to keep a $27 billion data center project off its balance sheet. EY ultimately blessed Meta's accounting treatment, but flagged it as a critical audit matter. That label matters because it's rare for a specific high-profile transaction at a major audit client. So what happened? Meta moved the data center project, called Hyperion, off its books in October into a new joint venture with Blue Owl Capital. Meta owns 20% of the venture. Funds managed by Blue Owl own the other 80%. A holding company called Bainut Investor, which owns the Blue Owl portion, sold a then-record $27.3 billion of bonds to investors. On screen, I want you to imagine what this looks like if you're a credit analyst. A massive bond issuance, a structure sitting adjacent to Meta's ecosystem. And yet, in the accounting presentation, the assets and liabilities don't consolidate onto Meta's balance sheet. The joint venture is described as a variable interest entity, a VIE. Meta says it isn't the primary beneficiary, so it doesn't have to include the venture's assets and liabilities. Now, the Journal points out the tension that any operator immediately feels. Meta is the hyperscaler. Meta is the one that knows how to run AI data centers. Blue Owl is the financier. Whether the venture succeeds economically will come down to Meta's decisions and know-how. So the question of who has power is not a semantic game. It's the whole game. And EY, in its report, says auditing Meta's decision was especially challenging due to significant judgment required in determining which activities most significantly affect the VE's economic performance. That sentence is basically an auditor saying, This is where reality hides inside definitions. And definitions matter, because markets run on reported leverage, reported capex, reported commitments, and reported risk. Now here's the uncomfortable truth, the reality check. This era of AI build-out is not just a tech story, it's a financing story. And financing stories always evolve into systemic stories when they become large enough and complex enough. The journal mentions a letter from 4 Democratic senators asking the Financial Stability Oversight Council to investigate risks that AI-related debt pose to the financial system, saying these arrangements are convoluted and opaque and make it easier to obscure the true nature of balance sheets, and pointing to Meta's joint venture as an example. I'm not interested in the politics of that. I'm interested in the signal. When auditors start using critical audit matter language on giant AI financing structures, the market is being told something in plain English. The clean, simple model of cap-light tech compounding is shifting. Some of these businesses are becoming infrastructure builders. And infrastructure builders always end up having a different relationship with debt, with cyclicality, and with scrutiny. So what are the lessons? Timeless, compounding-grade lessons. First, dependency is a hidden cost. Europe's energy dependency shows up as higher electricity prices, weaker competitiveness, and vulnerability to external shocks. Second, when a trade becomes obvious, the price embeds perfection. That's when rotations get violent, and bargains appear where the narrative is most hated. Third, if a business model is changing, the accounting will often change first, not because of fraud, because finance finds structures that fit incentives, and incentives always try to make the numbers look cleaner than the reality feels. And I'll end with one sentence to remember for years. When the build-out gets financed in the shadows, the risk isn't the technology. It's the leverage you don't see until the cycle turns. This is Avi. Like and subscribe. On to the next.